I'm going to try not to totally drone on and on today, and we'll be doing some more problems and stuff, so it'll hopefully be a little bit more interactive. It looks like just about everybody has signed up for MyLab and gotten linked into the course, so thank you very much for doing that. If you haven't yet, it would be worth you maybe taking a minute to do it now, just so that you can participate when we're doing the exercises here shortly. So as a reminder, in MyLab, the sample problems are all ones that we will go through during the class sessions. You don't have to do those on your own unless you're missing class. And even if you are missing class, you can go to the recorded class sessions and watch those, and they will walk through those. And those are all done with like the same, everybody should have the same versions of problems, I think, for most of those. Unless I accidentally do an alternate one, but I try to keep those the same. And then the homework ones you would do on your own, and those would be due usually a couple days after we finish the chapter coverage. So moving, anybody have any questions about MyLab or the course in general before we get rolling again on chapter 1? Okay. Thank you all for hanging in there in the afternoon on Friday. I know that it's been a long week, and this will be like the trying time of the week for everybody, but we'll try to keep it as interesting as we possibly can. All right, so there are some overarching assumptions and guiding principles with respect to how we do accounting that are very important for the quality of the information that we put out for investors and other people who are using financial reports that we create. So I think I talked a little bit on Wednesday about cost benefit. Did I talk about that at all or no? Okay. Well, so the number one thing when we're doing financial reporting and accounting is that we don't want to put more costs into reporting something or figuring it out than we get benefit coming out of it. So like you could track the whereabouts of every pencil that you purchase for your company and expense it one section of a pencil at a time as it was used up, if you theoretically wanted to, right? But it wouldn't benefit you financially to do so because you'd be paying somebody full-time to keep track of how quickly people are, running their pencils through the pencil sharpener, essentially, right? So on a larger scale, the same thing goes with like general supplies purchases and other things. There are some things that we just expense on our financial statements, and we don't keep track of like how quickly we're using them other than at a large scale sense, because tracking individual items for things that are really small and inexpensive becomes time consuming and unwieldy to deal with the volume of information that it creates. So we try to find a balance between having enough detail in what we're tracking for it to be useful if we have questions about it without overdoing the detail and spending too much time and money on information that will not help us make better decisions later on. So that's the cost benefit constraint, okay? Now, when we are doing accounting, we use an assumption called the economic entity assumption. And basically what that means is that when we are recording transactions and putting together financial statements for a business entity, we don't want to be mixing in its activities with another entity, right? So from a practical standpoint, what that can mean is that if you are starting your own business, you don't want to be like paying for all your business expenses out of your personal checking account and then reimbursing yourself later. A better way of doing it would be having a separate checking account where you have nothing in there other than the business's activities, so that you can more effectively keep the tracking for that business entity separate from your own personal finances. Same thing if you already have like an existing business and you want to start another business. Ideally, you would, set up a separate accounting system and a separate checking account or financial account for the new business so that you can accurately track that business's activities separate from your first business's activities. Why would we care about that? Like, you know, like, I own both of them, it's all my money one way or the other, so why would that matter? You think? Let's say that you started a new business, but you weren't sure if you're gonna have it going for very long. What would be some of the things you want to think about?
So if you're running that into business, right?
Mhm.
Now your credits is to come.
Yeah, so that's a very real concern. So legal separation. One of the interesting things about finances is that form kind of follows function with respect to legal liability. All right, so if any of you are taking or have taken principles of business law yet, you'll learn that later. But if you set up an entity which is a corporation, one of the benefits of having a corporation, which is corporation is not a general business term. It is a term that means a specific type of business entity that is set up as a legally standalone business entity, right? You have to register it with the Secretary of State in the place where you start the company. And the advantage of a corporation is that if you invest money into a corporation and then it gets sued for something, for example, and the corporation owes somebody $80 million because they created a terribly damaging product that, you know, really hurt some people and then they got sued for it afterwards, they can take everything that corporation owns, but they can't come after you as an investor for putting your money in there. So like if I buy shares of stock in McDonald's and then McDonald's decides to spray boiling hot coffee over their customers for a couple days and get sued by hundreds of thousands of people for it, they can't come after me and take my money away. What I'm limited to losing is what I have invested into that corporation. So my stock might become worthless, but they can't come and empty out my 401k or take my house away, right? Same thing happens if you start your own business. If you form a corporation and it's losing money, and it incurs some liabilities, or if it borrows a bunch of money from a bank and can't pay it back or whatever, unless you have also personally signed on it, they can't come after your personal assets for it, right? So that legal limitation of liability is one reason why you might want separate entities. Can anyone think of other, like, more accounting-based reasons why we might care about having separate entities? Sure. Taxes, yep. So same thing, it would be easier to identify your taxes. In some ways, it might be beneficial to have them grouped together for taxes because you might try to like claim more expenses or losses against the earnings of your other company. In that case, the IRS would want to tell you that they were separate instead of the same. But really, like from a planning standpoint, a decision-making standpoint, what you want to know is like, if this company is making money and this one's losing money, you'd want to be aware of this one losing money and exactly how much, so that you can make an accurate decision on whether you should continue operating that one. Because you don't want to have it like draining money out there because they're all in one checking account and not realize that this one company is like losing money hand over fist. When you think, oh yeah, I'm making a little bit of money on both of them, it seems to be doing fine. You want to be able to make the decision on whether to continue operating this one based on not just the overall picture, but how that one is operating, and then if there are qualitative characteristics like this one is supporting that one and bringing their customers in, maybe you'd be willing to take a loss on it, but maybe you'd not be willing to take a massive loss on it, you know, but you might not realize if you have them grouped together. So that is why we try to keep things separate, and we try to do accounting under the economic entity assumption, which is that each business and individual is a separate entity. So they talk about some different types of entities here, which are part of this chapter. So I talked about a corporation already. A sole proprietorship is like the most basic, simple type of company that you can start. It's the easiest type of company to start because it doesn't have any specific legal requirements to start it. You can literally just be like, I'm a sole proprietorship. So who here has had like a lemonade stand or something, or participated in one at some point? Or done like a car wash or something where you're like washing cars for people or mowing lawns? Anyone? Yeah? So you're a sole proprietorship when you do that. You're providing a service or a product to somebody in exchange for an agreed upon fee, and they're paying you, and you're a sole proprietorship. You didn't have to fill out any registration forms or anything like that in order to do that. You just were. Theoretically, you should, as a sole proprietorship, report your revenues and expenses on a tax return for tax purposes. Nobody's doing that for their lemonade stand, and unless you're mowing a lot of lawns, you're probably not doing it for your lawn mowing either. Although as a CPA, I have to tell you that you should. Nobody does. I didn't when I was growing up. But if you start a landscaping business, then you probably trip into that area where you probably should. But yeah, so sole proprietorship, simplest to form, least expensive to form. It also provides unlimited legal liability. So if you're mowing lawns for somebody and you run over their foot with your lawnmower, they're going to sue you for it, and anything you own is potentially subject to them taking it in court if you do damage with your lawn mowing business, right? So that's the disadvantage of a sole proprietorship, is that you have unlimited legal liability if somebody was to sue you for something, or if you sign on to a bunch of loans and you're like, well, it's my business, but it's a sole proprietorship, they could come after your personal assets if you don't pay the loan back, right? You might come and find your checking account has been emptied out by your bank to pay for your loan if you're not careful. Now, a partnership is sort of the next step up in complexity there. You don't have to have a written partnership agreement, although it's highly advisable from a legal standpoint. But a partnership is where you basically have more than one owner, but it can be an informal entity. One thing that's more complex than a sole proprietorship. Sole proprietors, if you file your taxes, you're doing it on your individual tax return because there's no real legal separation between you and the business. So there's a form Schedule C that you fill out for that one. A partnership, because there's more than one person involved, you can't just put it on like your tax return. You have to file a partnership tax return in order to report that. Now, the difference is the partnership tax return doesn't pay taxes other than like an annual fee at the state level. So, but what it does is it says, hey, this is what all the income was associated with this partnership. This is the ownership percentage for each partner that's in the partnership. And then it says, it has a form in there that you would give to each partner that says, this is how much this partner is going to report for income on their individual taxes. And this is how much this partner is going to do. And you take that form, and then on your individual, you take your share of the partnership income on Schedule E, your individual tax return. So then the corporation is totally separate entity, files its own taxes, and has total legal separation. A partnership does also provide like just a plain general partnership is also broad legal liability as well, much like a sole proprietorship, especially if you work for the partnership. The one exception there is if you have a limited partnership, you can have like one general partner who has legal liability and everybody else can be a limited partner where they're only limited to what money they put in. So that's one way in a partnership format of limiting liability. What you see more often than a limited partnership now is a limited liability company or a limited liability corporation, which is technically a corporation, but it gets taxed like a partnership. But it also provides the full legal immunity that you see under a corporation. So it's just a slightly different way of organizing. And that also does need to be registered at the state level in order to be a proper legal entity. So those are some different types of economic entities you would see. The only ones where you would see legal liability passed back and forth would be the sole proprietorship and the partnership. And then most often the commingling of funds between the owner and the business occurs in sole proprietorships, just because lots of people start out a business and maybe don't even see it as a separate business when they start it. So this just sort of lays out what all are the defining points between these. I've kind of talked about most of these. One requirement, an LLC can have one or more partners. So you can be an LLC or limited liability company with only one owner. Typically, if you have that situation, you will actually file a Schedule C similar to a sole proprietorship. So on your taxes, it would look like a sole proprietorship. But from a legal standpoint, you'd still have that legal protection. So if you start a sole proprietorship and then you find later on that you want to have more legal protection, you can actually form an LLC and then just put all your sole proprietorship assets into it and then do it that way. And you won't have to make any big tax changes that way either. But as soon as you add a second owner onto the LLC, then it would get taxed on a partnership form unless you made another election. That's tax stuff. I'm not going to get too in depth because there's lots of exceptions to those rules on how things are handled. Okay. So LLCs and partnerships are what are called pass-through entities from a tax standpoint in the US. They file tax returns if there's more than one owner, but they don't pay the tax on a form gets kicked out to the owners, and then the owners pay the tax on their individual tax returns for those entities. Okay, I already talked about those. So a lot of what we talk about in classes when we're doing accounting and stuff, we do with respect to a corporation. Just because it's the most generalizable. So we'll be talking about like stockholders equity. If you hear owner's equity, it typically refers to like a partnership or a sole proprietorship. But as we get further into all this, a lot of times we'll just be assuming it's a corporation. So this is how a corporation operates, right? You have a whole bunch of people who invest their money into a corporation. So they all own a little slice of it. And then there are owner member shareholder meetings where they will elect people to the board of directors. Now, from a realistic standpoint, not many people own enough stock in a company most of the time to actively elect boards of directors unless there's like some type of organizational group that builds a voting block powerful enough to vote someone on. So a lot of time those board of directors are kind of picked by like the original people who formed the company, and or other board of directors will recruit them, but then they have to get voted on and approved by the shareholders. The board of directors then technically is who hires the president or CEO of the company. The chairperson of the board is the primary go-to between those two. But when they say president here, a lot of times you'll see that referred to as the CEO of a company or chief executive officer. And then underneath that, you'll have a variety of vice presidents who head up certain areas within the company. So here they have sales, operations, accounting, human resources, and then they have a corporate secretary, which is typically like the chief legal officer. The chief financial officer or CFO is typically the vice president of accounting. You'll see that.
What's the COO?
The chief operating officer would be like the vice president of operations. Yep. And sometimes you'll see sometimes there'll be like a chief technology officer or chief information officer, sometimes like CIO. And other various roles depending on the company. So the key part of this though is that One of the big differences between a corporation and other forms of organization is that there is a separation between who owns it and who manages it. So within a corporation, owning shares of stock does not necessarily give you any ability to manage or interact with the actual organization in any way that will change how it operates, right? So if I go buy something on the stock market, if I go buy shares of, suppose it's no longer Twitter, now it's X or whatever it's called. I wouldn't expect Elon Musk to be listening to me when I say that he needs to do something a certain way within that company, right? Because I just don't have that ability. Whereas if I own stock in an LLC, which has like 3 owners, and I own a third of it, then they're going to be listening to what I say, possibly. But it depends also on how it's structured. So that difference between ownership and management is another significant dividing point between corporations and other types of business entities, I should say. Okay, so principles and rules that govern accounting. I talked about the cost principle, or I call it cost benefit. They call it in the text the cost principle. It's probably more often referred to as the cost benefit principle. Another assumption that we always keep in mind is that we assume that a company that we're doing accounting for is going to continue in operation unless we know otherwise, that it has a good chance of going out of business. And that's called the going concern assumption. We assume that it will be continue to be a going concern, is how they phrase that. If you receive a going concern exception on some financial statements that you have audited by an auditor, then that basically means that they think that there's a significant chance you'll go out of business within 1 year or less. And then the monetary unit assumption assumes that the values of whatever currency you're measuring those accounts in will be relatively stable over time. So if we look at financial statements this year and financial statements that last year, or like 3 years worth of financial statements, we assume that the dollar 3 years ago is worth relatively the same amount of money as it is now. Like, we're not repricing things based on significant currency values in financial statements. Okay, so an audit happens when we have, so I should refer to this as, so there's a couple different kinds of audits, but when you're talking about accounting, if somebody refers to an audit, they're usually referring to what is called a financial statement audit, where an independent financial statement auditor from a public accounting firm comes in, goes through your financial statements, and says, okay, we believe that these fairly represent the activities and finances of the organization within the time period that you say that is in the financial statements, and that based on what we are seeing, they are following generally accepted accounting principles in their presentation of these financial statements. So they'll come in, that's called assurance, for them to make expression opinion on the value, decision-making value associated with those financial statements that they have. The Sarbanes-Oxley Act happened in the early 2000s, and that came about because a whole bunch of auditors were accepting money for other types of services from the firms where they were doing the financial statement audits. And so they were arguably making poor decisions about whether those financial statements fairly presented the company's financial positions. And they were peddling less than desirable methods of hiding debt and other financial obligations by creating additional outside entities. And then in a nutshell, they'd say, hey, instead of company A borrowing money and having a huge loan on their financial statements, let's form company B, have company B borrow the money, and then have company B invest the money into company A, so that it looks like they have investment money or revenues coming in, instead of having loans and debts on their books. There was several super large companies that went out of business at the same time in the early 2000s. And it really rocked the, stock markets, and a lot of people lost a lot of money, so Congress stepped in and created the Sarbanes-Oxley Act that made a bunch of requirements for how public accounting firms can do their audits and what types of services they're allowed to perform for the companies that they audit. So, and then that act also formed the PCAOB, which is the Public Company Accounting Oversight Board, whose entire job is to watchdog the public accounting firms. And so they will basically audit the auditors. They'll go in and say, give us all of your documentation of how you did this public company's audit. And they will grade them based on whether they think they did a good job or a poor job, any mistakes that they found, any rules that were broken, and things like that. And then they make it all public. So different public accounting firms tend to be the I don't want to say victims because it makes it sound like they're suffering at the hands of the PCAOB for no reason. Probably a better way is the PCAOB tends to go in spurts of busting one firm or another based on how those firms are doing. And then so there's always a different firm that is kind of getting torn apart a little bit in accounting media depending on the given year. For a long time it was KPMG, and then it's been Deloitte for a while now in the last couple of years. Doesn't mean they're not good firms. They're great firms still, but you get one partner in there who is maybe encouraging their people to rush through stuff and not do the work they're supposed to, and then they can get some bad write-ups from the PCAOB. Okay, so that's the theoretical stuff. Now we're going to start getting down to brass tacks and actually looking at how to do some accounting, which will be more interesting and more interactive here. Okay, so the very most basic tool we have when we, which, you know, this is something that you will want to kind of internalize with respect to accounting, for financial accounting and for managerial accounting, and more if you end up going on, is what's called the accounting equation. So the basic accounting equation, which we see here, is assets equals liabilities plus equity. And these encompass basically everything that you will find in accompanying financial statements. And they are tools that we use in what is called double entry accounting. So every time we record a transaction in accounting, we record entries into two different accounts. And they will fit into this accounting equation, which we'll literally spend the entire semester learning how to apply this accounting equation to different kinds of transactions for businesses and record them appropriately, and then put that information into a usable financial statement format. So in this chapter and the next chapter will be sort of, could be a little overwhelming because it's like a foreign language in a way. Like what we're talking about is, it's a different way of looking at numbers than what you're used to. And there's a lot of like algebra involved here, but it's easy algebra, like the most basic algebra that you'll probably ever do. So assets equals liabilities plus equity. What that means is that if we have two of these three, we can calculate what the third one is, right? So if we're looking at this from an algebra standpoint here, we could also, if we could subtract one of these from your assets to arrive at the other one. So if you subtract something from either side of an equation, then the equation is still mathematically equal, right? So therefore, if we subtract equity from either side, then we would have assets minus equity on this side. And then because we already had equity here, liabilities plus equity minus equity equals just liabilities, right? So we can calculate what a liability number would be if we have the total assets and the total equity by doing that. We can also, oops, lost my little thing there. If we have that, we can also say, okay, well, if we want to take our assets minus our equity, that would equal our liabilities. So if we just take that and subtract it from both sides, we end up with assets minus equity equals liabilities. We can also come up with subcomponents of these the same exact way. So let's say we have a list of different things that are all equity, and we know what our assets are, and we know what our liabilities are, and we know all the other equity ones. We can solve for that last one by using the same accounting equation. So that's kind of what we'll be doing a lot of in this chapter and the next chapter. All right. So, but first we need to know what is an asset, what is a liability, and what is equity, right? Because it's all good to have the equation, but if you don't know which items are supposed to go into each category, then it's sort of useless, right? So an asset is an economic resource that we expect to benefit from in the future. All right. So economic resource, you'll pretty much always hear that in the definition of asset. So that will provide you some type of future use or benefit. So things like cash, inventory that you could sell, furniture that you could use, or equipment you could use to produce future things that you would sell, land where you could build a building, or you could sell it. All of these things would be considered assets because they can be converted into cash to create cash. So cash is the very simplest asset that we would potentially have as a business. We'd start with that. We'd use it to buy other assets. We could sell those other assets and convert them back into cash. Also included in assets would be money that people owe us. So like if I were to lend money to someone else, I may give them my cash goes down, but if I have a promise from them to pay me later on, that legal promise to pay is also considered an asset. So that could be an account receivable if it's related to my primary product or service, or it could be like a note receivable if I'm actually just receiving cash payments back from them for money that I loaned them at some point. Now, on the other side, we have liabilities. So liabilities are things that we have to use our economic benefits for later on. Like money that we owe to outside people or entities that will require us to use up our assets at a later point in time. So lots of times like current liabilities will have the word payable in the name, and that means that we would probably be paying for that in a year or less. So accounts payable are bills that we get from vendors for things like utilities, inventory purchases, other day-to-day type expenditures where we maybe didn't pay for it right away, but we're expected to pay usually within like 30 to 90 days for a payable like that. A note payable would be like a borrowing from a bank. It could be either short-term or it could be long-term, depending on when we're supposed to pay that money back. Salaries payable happens, like most of you have probably had a job at some point in time, right? How do they pay you typically at a job?
The wage.
A wage, right? And how often do they pay you?
Every other week.
Every other week, or some businesses will pay weekly. It's very rare for them to pay you more often than that. They're not going to be like cashing you out at the end of your shift and being like, here's your wages for today, and then doing that with every employee every day, right? Because that'd be super time consuming and expensive. So salaries payable is basically like, in the meantime, if I've worked 3 days and I haven't been paid for it yet, that company owes me a salary payable. So at the end of the month, when they do their financial statements and their financial reporting to look at where they're sitting for the month, they will probably have a certain number of days in their pay period that they haven't yet paid people for, and they would record that as a salary payable in their financial statement. So those are some different kinds of liabilities you might run into. Mortgages, car loans, vehicle loans, all of those would also be liabilities as well. And those would be like longer term liabilities usually.
Insurance.
So insurance would probably be, so interesting thing about insurance, a lot of times they make you pay up front for insurance. If they're billing you monthly, it would be a payable for the time between when you get billed and when you owe it. So. Depends on the insurance company, but yeah. So those would be like a short-term payable, yeah. Now, the last component in that accounting equation is equity. So that is the claims of the owners on the assets of the company. So if we go back to that accounting equation that we looked at, assets equals liabilities plus equity. This right side of the equation is all people who have a demand on those assets. People who can come in and say, you owe me a part of that, those assets that you have. Some of them are loans where we've borrowed money, equipment, supplies, or whatever, or they've issued us credit for it. They've given it to us without requiring us to pay for it up front. So, but they have a claim on those assets. And then some of them are people who have invested money into the company and therefore they own what is left that is not essentially owned by the people we owe money to, right? So from a legal standpoint, a liability is a legal obligation to pay some of our assets out in the future to an outside entity. And everything that we don't owe to someone else, we as owners own within that company. The interesting thing about that is if you borrow a whole bunch of money and you aren't making much money, you could end up with a situation where you have more liabilities than assets and you have negative equity in this equation. In which case you're kind of upside down. So if you borrow too much money, you could end up having negative equity within this accounting equation. Most places will not knowingly lend you that much money though. Usually when you see situations like that, it's where an owner has multiple businesses or something and they're loaning money to their other business that's losing money from something that's making money. And or they put money in there, but they don't want to put it in as equity because they want to have it paid back to them eventually. So there's a few ways you can wind up with that. Okay, so within the equity, you can have contributed capital, which is like, say I am an investor or I'm starting a company myself and I'm going to put like $10,000 into that company to start it out. That would be contributed capital that I'm putting in there. In a corporation, you typically see that recorded as what's called common stock. So it's just a basic block of ownership within the company. Now, the other way that you can develop equity within your company is by having profit. So if you sell products or services for more than what it costs you to produce them, then you have increased the assets of the company overall, and therefore you have what are called retained earnings as long as that money is within the company. So let's say that I sell $100,000 worth of stuff, and it only cost me $60,000 to make that stuff or to buy that stuff. I've made $40,000 in net profit. I either have receivables from my customers or I've actually received cash for those. So I have more assets than I started out with overall, right? As long as that money is not withdrawn by me outside of the company, it sits there in what is called retained earnings. So in a nutshell, it's earnings or income that is still sitting inside the company or has been retained by the company. Now, if I pull that money out and say, hey, I made $40,000 of profit this year and I want to take some of that profit out, I'm going to take $10,000 of that out. It gets subtracted out of the retained earnings. It is no longer retained because I have distributed it to myself. And then that is what we refer to as a dividend. Or an owner withdrawal, depending on the type of entity. Okay, so how do we increase our equity? Well, by having revenues more than our expenses, or by contributing capital in, right? So revenues or sales increase your equity in the company. Dividends or withdrawals from the company and expenses both decrease your equity in the company. So, and the definition of revenues are money that you earn from the ongoing operating activities of your company. And then expenses are costs that you incur related to the everyday activities within your company. Yes.
Would equity still increase in a sole proprietorship if from contributing capital?
Yeah, so I mean, you could have owner capital in a sole proprietorship if you're putting the money into a separate account. It's less of a legal distinction because technically, from a legal standpoint, there's no difference between you and it, but you could have contributed capital in a sole proprietorship too, if you wanted. And in fact, I would track it that way. Like, it would be beneficial for you to understand, like, oh, if I put this money in there, I want to keep track of my investment that I put in here. Especially if you are continually putting money in there, you'd want to definitely track that so that you know exactly how much have I invested into this business versus what type of income has the business generated on its own. Okay, so this slide kind of breaks out in a little bit more detail that accounting equation, and it includes common stock, also known as contributed capital. You wouldn't have stock in a sole proprietorship, it would just be considered like owner capital. And then retained earnings incorporates your revenues minus your expenses, and it also, you would subtract out any dividends that were paid. I kind of feel like the dividends will go over here because you're not going to pay dividends until after you've had some revenues and expenses, but I didn't design the textbook, so nobody asked me. Okay, this then. All right, so now that we know about the accounting equation, we're going to figure out how do we apply this to recognizing how we should record a transaction in an accounting system. All right, so a transaction is any event where we have a change in financial position between ourselves and someone else. Okay, so it has to affect the financial position of the business, and you have to be able to measure it with what they call faithful representation, which means we need to come up with a meaningful number that makes sense and is verifiable, essentially. So the steps for this is that we first have to identify what types of accounts we're dealing with here, and there will be 2 accounts for any transaction because we're using that double entry accounting system. We need to decide if each account is becoming larger or smaller, and then we have to figure out if we've balanced it properly using our accounting equation. Now, deciding if something increases or decreases sounds super simple, but we also incorporate what are called debits and credits into this situation. So looking at the accounting equation, we can record something in any given account with what is called a T account, all right? So here is cash, and if I'm going to increase, so cash is an asset, and if we are going to record increases to cash, we would mark those on the left-hand side, and if we're going to record a decrease to cash, we would mark it on the right-hand side, okay? And there's a technical term for which side of this T account you're using. The left-hand side is referred to as debits, and it's abbreviated DR, so D-E-B-I-T. And the right-hand side is referred to as credits, so C-R-E-D-I-T, same thing. Now, all assets will increase by making a debit on the left, or decrease by making a credit on the right. Okay, here's where it gets fun and makes people angry sometimes. Assets are on the left-hand side of the accounting equation, right? On the right-hand side of the equation, we have liabilities and we have equity. So if we do a T account for a liability,
debits are still on the left and credits are still on the right. However, an increase in the liability is a decrease in the value of the company. So to increase a liability account, we credit it. And to decrease a liability account, we debit it. So it's the anything that's on the right-hand side of the accounting equation, a credit will increase it. And anything that's on the left-hand side of the accounting equation, aka assets, a debit will increase it. Okay? And that'll make more sense to you when we start actually like writing out some journal entries here. So this part is very amorphous and kind of abstract. So if you're feeling kind of like, right now, that's fine. Just trust me. And we'll go with it. And it'll gradually make more sense as we practice. Okay. So knowing that a liability and equity are both on the right side of the accounting equation, how would we increase an equity account?
On the right side.
On the right-hand side, yes, exactly. And then we would decrease it on the left. So writing this down and having it somewhere handy for like the next couple chapters will be very helpful for you. Or just printing out, there's a slide in here that actually I think has all of the different account types on it too. Printing that slide out. I'll try to bring some of those on Monday that you can use as cheat sheets. I should have brought them today, but I'll try to print that out. But if you're working on homework or something over the weekend and you want to do that, just find that slide and that'll help work as a reminder for you. Okay. So when we look at a transaction, the first step is identifying, kind of the pre part before you even do these steps is figuring out if a transaction has occurred. So looking here, they have two examples. One is buying a computer for the office for $2,000 in cash. That's pretty simple. Cash changed hands. There's a transaction there, right? What about if I buy a computer and I don't pay for it right now, but I have to pay for it later? Is that a transaction? It is, right? Because I'm expected to pay for it later and I will get in trouble if I don't. So I have an obligation to pay for that. So that would also be a transaction. What about if I win a computer or somebody just gives me a computer? And it's like, here you go. Is that a transaction? Not really. The only time that would be a transaction is if you're a nonprofit organization and you're accepting like an official donation, right? Same thing, difference between buying a coffee at Starbucks and then Starbucks sitting outside and handing people free cups of coffee. Them handing you a free cup of coffee, like for me is not a transaction because I'm not paying for anything, all right? Okay. Hiring a new employee. That is not a transaction either because there typically isn't a financial obligation there. Now, if you hire an employee and then you promise to pay them a recruiting bonus, at the time you pay them the recruiting bonus, then that would be a transaction because there's some economic exchange occurring. Okay, so let's start off with the very first type of transaction that we might have before starting a business, which would be a shareholder contributing into a business that they want to start. We've got Sheena Bright. She's contributing $30,000 into a corporation in exchange for some stock in the company. So what we would have is an increase in our assets, and we would also have an increase in our equity over here. And here's where the double entry accounting part gets cool, all right? Anytime we make a journal entry, the debits and the credits have to be equal in that journal entry, okay? So this is an overriding rule. So anytime you're doing an entry, if you're adding up your parts, you're adding up the debits that you came up with, and you're adding up the credits. If they're not equal in total, then you've probably put something on the wrong side, like either made it a debit instead of a credit or similar. So looking at this from the accounting equation standpoint here, we talked about the fact that if we're increasing our cash, which is an asset, then that would be, if we're making a T account for cash, we have debits on the left and we have credits on the right. An increase in assets would be over here. So we would debit cash for $30,000. Now, on the other side of the accounting equation, we've got equity here, and we've got our common stock account. That common stock, as we said before, increases by crediting and decreases by debiting. We are increasing our common stock here, so we would put the $30,000 under the common stock on the credit side over here. And voila, our debits in this transaction equal our credits. We've increased our common stock account, we've increased our asset account, and we can state that then on a financial statement by just saying like our assets equal $30,000 and our equity equals $30,000 after this transaction. Make sense? Sort of? Okay. All right, so the next thing we've got here is we have a purchase of land for cash, right? So what type of account is land? It would be an asset, right? Because we can use that in the future or sell it if we want. So here we have an increase in one asset and we have a decrease in the other asset. So from a financial statement standpoint, or from a T account statement, we've got cash and we've got land. They both increase with debit and they both decrease with a credit. So we would then, if we are paying out cash, that decreases our cash, right? So that would be 20,000 here. And then we increased our land by what we paid for the land. So we have a debit of $20,000 to the land account, and we have a credit to the cash account for $20,000. Right. Is that making sense? So let's just do really quick here while this is still fresh. Let's go back to that problem in MyLab that I just had up a minute ago. Problem number 2. They gave us a list of transactions here, and they want you to go through the 5 transactions and record where they would go into this accounting equation, basically. So they give us the equation at the top here, and then we just have to kind of plug in what's going on. So the first transaction we have is receiving $1,700 to issue common stock. So take a second and just look at your accounting equation in MyLab and just think about it the way that I did it there with the T account, right? I could actually do this in Excel here as a T account also. Yeah, it's a little more complex. Common stock and cash. So one thing that they are doing here that's a little bit different from how I was showing you is that they aren't asking you to figure out yet if it's a debit or a credit in the problem. They're just asking you if it increases or decreases, right? So if we receive $1,700 and issue common stock, is our cash going up or down? Up, right? Because we're receiving cash. And then what about our common stock? Is that one going up or down? That's up also. Yep. So for this problem, we would just go ahead and put that in there. So cash, we've got 1,700, and then common stock, we have 1,700, right? All right, so then for the second transaction here, we're purchasing a mower on account for $1,440. So we didn't quite get to this type of transaction yet, but what they're saying here is we purchased this mower without paying cash for it. So now we are going to have an account payable. So anytime you hear the phrase on account, it refers to either an account payable or an account receivable. Like if you
Ignore the whole rest of the sentence. On account is a payable or a receivable. Then you look at what is the transaction that happened. If I owe someone money, it's an account payable. If somebody owes me money, it's an account receivable, okay? So if we purchase a mower on account, do we owe someone money or do they owe us money? We owe them money, yeah. So that means that we would be increasing our equipment account, right? Or assets. And then we would be also, would we be increasing or decreasing our payables? Increasing, right? Yeah, because we would be owing them that money. Okay, so 1,440, so. Okay, and then they're asking us to say, okay, what is our balance of these various areas at the end of this? So let's go ahead and just add up each of these columns, which should be pretty easy here. So our common stock has 1,700, our accounts payable has 1,440. Whoops, what did I forget? Oh, let's see, I didn't put zeros in here, sorry. I think it wants zeros. Yes, enter 0 for any 0 balances. So don't forget that part. Okay, so we'll do this third one and then I'll let you go. So the third one, performing lawn services for a client on account for $200. So here they're getting really fancy, all right? So our business is performing lawn services. So mowing lawns would be our us generating revenues, right? Based on our daily operating. So we're increasing our revenues by that $200. And then, did we receive cash for this? No, we did not, right? So then I mentioned that we would have, I'm going to plug this in here under service revenue for 200. So then where would we put that 200, the other side of this entry for 200 based on what we were just talking about with on account? On receivables, right? Because they owe us the money. Yep. So, all right. So that just gives us these balances here then. So don't forget to hit check answer and submit that so that it saves what you've done so far. Because these are worth participation points, even though we're walking through all the answers together. All right, and we'll finish this problem on Monday, or if you want, you can take a stab at it. There's 2 other transactions in there. And then, so we'll finish that, and then hopefully we will get through the rest of chapter 1 then on Monday, and then we'll roll into chapter 2. Sound good?
Good.
All right. Have a lovely weekend, everybody. Thanks.
We'll see. It's still.